been issued by government or kings, but it can also have been privately issued. For instance, banknotes for most of the time have been privately issued. The other option you have is to pay with a credit or a debit card. A credit or debit card, for you, look a bit the same because you're just paying the money to the vendor, but from a legal perspective and how it's structured, it's absolutely different. The credit or debit card is just ordering the bank to give the funds to the vendor on your behalf, money that the bank already owes you, or that you will know owe to the bank, right? So if it's a credit card, you're creating a new credit, and now you owe money to the bank, and this money is being sent to the coffee. So that are the two different options, and that you might have. Just to get back on the beginning of banknotes and how that exactly works, these physical aspects. A good example is the beginning of the 18th century. The first banknotes were being issued by banks in the United Kingdom. And this is a story of a man that was called Crawford, and that wanted to pay a friend by sending via mail some banknotes to pay him. For whatever reason, he got stolen, and the banknotes got stolen and never reached his friend, and ended up at the Bank of Scotland. So Crawford went to trial because he was smart enough to have taken the number of the banknotes, as you can see it's quite obviously displayed, and to know that it was his banknotes that had been stolen and that were now at the Bank of Scotland. So he was saying, those are banknotes that have been stolen from me. I would like to get them back. And what decided the judge is, in the end, that it couldn't happen, because if you had to follow the trail of the banknotes, you could never be sure that you've been paid at the moment you paid. So you need to be confident that when you get banknotes, this is fully you getting paid. And that's how currently works every kind of cash. So basically, we can summarize it by, it was the first time where judges decided that, well, probably not the first time, but they decided that whoever possesses the cash at some point is the owner of the cash, which is absolutely the opposite of the banks and the bank accounts. So to summarize, the possession for cash determines who is the owner. For the bank is the bank ledger that decides who is the owner of any cash that's on it. The cash is issued and published by the central bank. So it used to be private institutions or sovereign. Currently, it's central bank that prints the cash. The bank accounts, the money that's on it is issued by the commercial bank itself. The transfer of cash is instantaneous. At the moment you give it, you've transferred it, and a transfer in the bank account will always take at least a few minutes and probably days. And another way to see it is also to say that the cash is bearer, so it's whoever has the cash is the owner. When the bank account is nominative, so you have a name in front of each fund, and so you can know who is owning the fund at some point. So currently the plan is to use some of the properties of digital cash in the digital world, because at the moment we have only on the digital form the bank account, and on the physical form the cash. So obviously you've heard about Bitcoin. That was the plan, and it's not absolutely a detail that in the title it was presented as a form of digital cash. So it was exactly designed with this comparison in mind, and to say that I create an instrument that allows me to pay instantaneously, that whoever is the bearer, so in that case the private keys, is the owner of the cash. So it's easier for me to settle a transaction, because I know that at the moment I got paid, and there is no intermediary and more complicated process. Currently, many institutions are considering how they could build on that idea and try to provide some of the properties of the cash to the digital world. One push for this is currently the fact that many of modern economies are getting more digitalized in general, having more access to internet, but it's not necessarily fully correlated with the fact of having a more cashless society. So some countries still have a widespread of the internet and still keep a lot of cash in their day-to-day payments. One of the most advanced example of the opposite, and we're going to talk again about it, is Sweden, that is slowly removing most of its cash and most payment is going cashless. So there is a need to switch from the cash, as it has also costs, to handle the cash, to keep the cash physically and protect it, to ensure the fact that you all have cash. And so there is this need to move forward. Another interest of this and why there is this plan is also that central banks are interested in controlling exactly the amount of money that is in circulation. As I mentioned before, the cash is directly issued by the central bank. The money you have in your bank account is not directly issued by the central bank. So they have some control over it indirectly, but they are interested in being able to better control the amount of cash in circulation. Another element is also a more geopolitical one, why there is this debate and competition, is that currently most of the international trade is happening in dollars. Most of the reserves in central banks are dollars. And there is a will from many countries to move beyond dollar. One reason is what's called the militarization of dollars. It has been used in the recent years for sanctions since 9/11, but also since the end of the deal with Iran and with Russia also since the invasion of Crimea. So there are many countries now that are under sanction and are looking for alternative mean of payment than dollars, because usually the sanction apply if you're using dollar in your transaction. So this is a map that has been designed by written by the Bank of International Settlement, presenting the different options of forms of cash that could happen in a digital world. So on the left, you see you have the cash as it exists today. So it's widely accessible. It's issued by the central bank. It's peer-to-peer, so I can exchange cash with somebody else, but it's not digital. And the main two projects that are being worked on at the moment are central bank digital currencies on the retail level and the wholesale level. The idea generally is to provide some sort of cash that is digital, issued by the central bank, peer-to-peer, and so either widely accessible, that's the retail central bank digital currency, or wholesale, so it's going to be only between institutions to have some form of cash that's going to have those properties. Another one is also digital currency, but also you have private institutions that are looking into creating also some sort of digital cash. Some example of this, so e-krona, that's the project of the Bank of Sweden I mentioned before. Those are private settlement coins. I'm going to get back on this later, Bitcoin and other types of projects. So this flower has been proposed in 2017, so it's been quite a time that institutions are looking into it. It's not absolutely new. And yes. So what are the key challenges that are facing those institutions trying to create a form of digital cash? First, convenience. So any form of digital cash needs to be easy to use by users. It needs to be understandable, and cash has the property of being really physical and more easy to understand for everybody. So it's a huge challenge that's going to happen in the following years if these kind of projects are rolled out, is to be able to design it in a way that people understand it so they don't get also frauded in any form, because they can perfectly understand what happens when they are transacting and so on. So already on Bitcoin, you have many frauds by tricking the interface and so on. So if you imagine that the public at large were to use it, that would complicate things. The second key challenge, and that's often overlooked by institutions looking into that, is adoption. I insist on it because at the moment, for payments, I've mentioned, so you have cash and bank accounts, but if you look worldwide, you have a very different landscape depending of every region. So there is no path that's clear from moving from one technology to the next one. It depends of population, what are they used to, what they want to use. And one example of that is, this is within the European Union. On the left, you have Greece. On the right, you have, I guess, Sweden and a few Nordic countries. And so in blue, you have the cash. Then you have cards in yellow. And then in orange, you have other form of payment. And so, as you can see, even just only within the European Union, you have a really different landscape in terms of how much cash is used versus other form of payments. The same goes if we look at other new form of digital money. One is mobile payments. So, you know, mobile payment is the ability using your mobile phone. It doesn't even have to be a smartphone to have some credits with your telecom provider and to be able to send some currency. And the same if we look at different regions, there are a very different landscape in terms of how much mobile money is used and how much it has been used recently. Especially looking at international payments. So remittance is usually a family that sends back, that's in a more developed country and send back money to the family. And so depending on the region, it's more or less used. We could look at mini graphic with the same idea. If we look at China that has adopted mobile payments, but through an app, so it's another means of payment also. So if we look at every option on the table, we could look at one region where it's widely adopted and others where it didn't catch on at all. So that's a key question adoption. Another one is privacy, of course. If we are to create a large digital coin, we want to be sure that there is some privacy. So privacy means different things. Of course, in the more crypto sphere, we are aware of the risk of governments looking into what we are doing, but there are also competitive privacy, for instance, in the sense that a bank might not want other banks to know what are their current position in different assets, so that there might be some challenges in this. Crime, so that's bear stealing some gas to get intoxicated with it. Because if we move to digital cash, of course, there are new type of crime that are going to be easier. We already have that with Bitcoin. And so that might increase some certain type of crime. There are two branches in this. One is, I would say, individual crime. So people stealing your money in some form, like a scam or somebody accessing your computer to get your keys. So that's one problem. Apparently, currently on cash, it's quite low, actually. So if you look at the amount of payment that are done in a country and how much cash has been stolen, it's really a small percentage. So if we were to move to digital, would that increase? The second branch of crime related to a digital cash would be, of course, money laundering, terrorist financing, and all this. This is more a question of scale. So if it were only allowed for small transactions, it wouldn't change much the current landscape. But if we had a digital cash that would allow to move large amount of money without being traced, we would have a larger problem. So I know that in the crypto sphere, we are more conscious about the risk of the government, but this is also a risk that has to be taken into account when we design an institutional digital currency. Then there are technical risks. So technical risk is, of course, the risk of failure, the risk of not being available, and that's huge because if all the payments happen with this digital system, it needs to be perfectly reliable. But also, by digital risk, I think about just the operational costs, and that's not a detail because if central banks are considering creating this kind of system, they would be really happy to design and control a full system. They are not really happy with the idea of having to operate a large payment system at the scale of the country. Most central banks are not equipped and don't have the resources to exactly do that. So a key question is who's going to be bearing this operational cost and responsibility and having to handle it day to day. So a few elements on design based on this. So first, the basic element is how the value is guaranteed of your cash. So if it's a private digital currency, the basic idea is to have a reserve. So that's how Tether works and all those stable coins. You put some money aside, and that represents your value. So then the value can be transferred peer-to-peer or via an intermediary, it doesn't matter, but then the value is always guaranteed by a central actor that has a reserve. Of course, if it's issued directly by the central bank, that changes everything, because then the digital coin that you are exchanging is directly the value has a value that the central bank wants it to have. Another element of design that's separated is the question of intermediaries. So I mentioned the risk of crime, the technical risk, and it's most likely that whatever is the design, there are going to be some intermediary, especially for compliance purposes. For instance, checking the identity that whoever is going to be using this currency. So you're going to have people who are going to, so for instance, taking the money to set it aside, but also taking identities and checking them. And they're going to be responsible every time people transact to identify who are the different users on the systems. And so, yes. So then, if we look more broadly, so that was the two kind of legal elements. And now if we combine them, one of the systems that is being discussed at the moment is called interbank digital currency, or in literature you see it also as wholesale digital currency. The idea is to have a digital currency that's going to be only between the banks and financial institutions. And as a private citizen, you're just going to have a regular bank accounts with your institution. So for you, it doesn't change too much, but it's going to change a lot of transfer between banks. At the moment, they have huge costs when they are transferring and exchanging assets, because actually they don't trust each other too. And they don't trust much the commercial bank issued currency, so that's a cost in transfers. But for the end user, it's not going to change so much, because you're going to still have a bank account, and your assets are going to be controlled by your bank. That's going to be the one knowing how much you own. A variant of this is called settlement digital currency. We saw it in the flower on the lower part. So the settlement digital currency is basically the same. The difference is it is privately issued by a private bank, and that there are a few projects like this. One is called utility settlement coin. There are a few projects with this perspective. Another idea from this is to do a retail central digital a retail digital currency. Here it would be different, because the value would still be guaranteed, for instance, by the central bank, but then you would be directly able to exchange it peer-to-peer. So that's the part we could get the most excited about when we are interested in the existing crypto ecosystem, because you wouldn't have the intermediary or the risk of a system like DAI, for instance, for guaranteeing the value of your stablecoin. You know the value is guaranteed by the central bank, so you can at any time redeem it and get it. But at the same time, you have a system on which you can build and have a full ecosystem being built. So that corresponds the most at what most of the crypto ecosystem is working. But another design that's actually getting more popular among central banks is mostly the idea of a central bank accounts. So sometimes they discuss if there would be a ledger at the central bank level, but I don't really see much the point. In the end, it will be every user would have be identified by their name, so it would still be nominative, not being bearer. You remember the distinction. And you would have intermediaries that just manage your identity, but then it would be the central bank that manage the line for each person. So you would have something that's closer to cash, because it's issued by the central bank and you're guaranteed you're going to receive it, but you still have an intermediary that's going to be managing most of the operational costs of using this currency. So if we look at current prototypes, That's the design of the JP Morgan coin. So it's basically a settlement coin. So as we discussed before, it's just a coin that's issued by the bank that would be used between banks to settle some transfers. I'm not sure it's really as active as it has been at some point, but so that was one of the ideas, but there are many projects competing with the same kind of idea. A second type of project is Libra. Of course, you've heard of it. It's typically, so it's at a retail level. So from what I understood, the user would still be able to manage, but there would be intermediaries so that are handling your identity and controlling access to the system. So it's still a digital currency. You still have a token issued that you have or you don't have, but you have intermediaries also in the loop. And of course, for guaranteeing the value, it will be a reserve. And if you've heard since a few weeks, there has been discussion that they wouldn't use a panel of currencies, but use only one currency for one token. So to make it easier for most users, but also for regulatory compliance, it's easier to have just pegged one-to-one than to create a new basket. And then if we look at Sweden, so that's the adoption of cash in Sweden. Sweden is in blue here, and you see how low it has gone in the usage of cash. They are working on a project that's called e-krona. And so that's the first version of e-krona. And so that's interesting because I think they have moved between a few years from one design to the other one. Their first design was typically what I was talking about with having a ledger between the participants. So participants are banks. So it's in the end, they are like intermediaries of the payment system, but it would still have been a currency that's been issued by the central bank and that you can have a digital wallet and transfer and so on. So that was the first iteration, but the second iteration, that's, so they have published two reports, report 1, report 2, is actually a totally different idea. And basically you have the users in the end, an interface and just one e-krona platform. So it's going to be one central system that manage all the coins. And then you have external systems for the companies, for clearing organization, payment service providers. So all the services and intermediaries are considered like an external system to the main transfer that are going to be happening at this level. So if you look back at the designs, we are exactly in this case. You have one system managed by the central bank, and then you have intermediaries helping with the system, but there is no more the idea of a ledger that's managed between the participants. So it's interesting because they have been thinking about that, and they came up with this design after a few years of working on it. So it might be a sign of other projects to come. If we look back at what could be done using technologies that are more familiar to us, so more blockchain-related technologies, currently we have the choice between different platforms. So we could look and see the interest of having different consensus algorithm, different clients, and so on. So that's if we were to look at the initial design, for instance, of e-krona and what would be the option available for them. Currently, when they are studying this kind of platform, their main focus is actually how we can combine privacy and auditability. Because, of course, you want to have privacy for users. I said before, for protecting the privacy of the user, but also for competitive reasons. But at the same time, you want to have auditability to be sure that you are able to detect if there is a money laundering or other related crime. So that's why there's been a report recently by the Bank of Japan and the European Central Bank comparing different techniques to protect privacy and what are the interests and drawbacks. So they classify privacy enhancing techniques, how they call it in the report, in 3 categories. One is segregating. So segregating is the idea that you're not going to show what information is on your ledger. So segregating could be like, for instance, payment channels, because the information is not shared on the blockchain, or Corda Hyperledger Fabric, where you have like different channels depending on the participants. The other category of privacy enhancing technique they consider is hiding. So hiding would be using cryptography mainly to hide the transaction. I'm not sure that quorum private transaction is not actually also a form of segregation, but we could debate that. And the third part is called unlinking. Unlinking is saying you have a blockchain, it's mostly public, but you could break the links between transactions, so you're not able from the outside to know whose person has paid what. For instance, Monero is using a lot of technique related to this. And they are trying to consider which one are still auditable. So from the point of view of you would have some regulator in the loop that wants to be able to know when they need to. And so they consider here the solutions that are more auditable. Of course, a solution segregating like Corda, Hyperledger Fabric, you can still access to the information in some place. And considering on the other side a solution that are less related to that. So that's all for today. Thank you for listening. Yes, if we have time. Yes?
Thank you for this presentation. I have, let's say, two questions. First, what is the difference between digits and tokens? And the second one, which is following, so I'm already asking it. What is difference from what is done since decades with, because everything is already digitalized in the monetary system?
So on the second question, what is different? The difference is to have the properties of cash. So for instance, one of the properties of cash is to be an instant settlement. At the moment I transfer you cash, there is no ongoing process. I gave you cash, you have the money. When I send you money through wire, there is actually going to be hours or days before the transaction is fully settled. It's a problem for two individuals, but it's even more problem between banks because when they are buying, for instance, a large amount of shares, they want to be sure before they give away the share that they have the cash. And so having some sort of digital cash that allows them to be sure at a certain second that they have the cash, that's a great asset for them. Then for the first question, I'm not sure what you meant by digits exactly compared to tokens. But
so you're basically saying, just to, because the two goes together, so you're basically saying that you have a problem of settlements, which is for me is a concern of digitalization rather than blockchain or mutual ledger. And what I was referring to digits versus tokens, that's the difference for a token is a digit, but it's a particular digits. In the field we are, it's a transferable digits. I mean, it's a digit that if you have it, you can transfer it. And from what I understand, you don't have a problem of transferability, you have a problem of settlement, identification, and what you need is a centralized system, not a distributed system, but a centralized system with proper settlement and clearing mechanism.
Yes, so to be clear, the central bank are at the moment, so the vocabulary they are using is to distinguish on one side token-based instruments, and that's related to what I started with to say it's a bearer instrument. So whoever has a token at some point is considered the owner, unless it's clear that they have been stolen, but that would be the first. The other option they are considering is account-based, so it would be nominative. You could still have KYCs, they would know which user is using an account, and for instance, Libra is going to that, but still being a bearer instrument. So you would know who is the owner of a particular wallet, but then whoever has it at some point is considered the true owner, unless there is really a problem, and we have to get back. Okay, we're happy to discuss about that. But that's the two options.
Yeah.
Yep.
Thank you for the talk. Actually, I was wondering, you didn't mention one of the main reasons why we should upgrade our currencies is probably the programmability, right?
Yes.
So would you say that are they thinking about this when they try to implement all the central banks, when they try to implement the digital currency? Do they have this in mind? or do you think it's more like yeah, they want to just solve the current situation or improve it more than really change something?
No, they have that in mind. That's definitely. I'm not sure it's their priority. So the question of monetary policy are more relevant. The question of who's going to be the players that are participating in this system for basic transfers is more relevant. But as I mentioned at the moment of saying, if we had a ledger that would be accessible to most users but still being guaranteed by the central bank, I feel that's the place where you will have the most innovation. If it's centrally controlled, it could work too, but they would have to be really rigorous in providing the right APIs and the right easiness to go to one. It's part of their reasoning, but I'm not sure it's their first priority, if that answers your question.
Okay. And I just have another question. When you mentioned, like for example, if the central bank directly issue between citizens the currency, and then we don't really need commercial banks, right?
Yeah.
So how would you, in this case, that would be the most, I guess, useful and disruptive, but how do you see the commercial bank accept it? Would they kind of convert and maybe run some nodes, or like how would you see the scenario?
Yes, I think that would be actually quite desirable to have a competition, because currently it's quite oligopoly that if you want a bank account and some sorts of digital money, you have to go through one of the few banks you have in your country. I think that's one of the part that would bring the most value, but also that explains why it's going to be slow and difficult to do. The idea would be that banks would have to reposition themselves, so they would have to provide better additional services. They would still have the function of investment, so we would have to figure out how they get the basic funds, but it doesn't make sense at the moment to explain that the banks are investing in the economy and choosing where they should invest on one side. So
yeah, wait, can you just continue this outside, I guess? We have to cut it short.
Sure.
Now.
But so the idea would be to separate. One thing is the cash you need, and actually the cash you need is not in the scope of the banks. And what are the really function we need a bank for? So that would be the question. But as it's a transformation, it's going to be slow and long process. Thank you.